Hello friends, we'll be learning another comprehensive problem which will include a lot of other ratios will be a part of this illustration. So let's figure out how to go ahead with that calculation. So when we speak about ratio analysis, we understand that we are doing the functional approach and we'll be using the four kinds of basic parameters, or rather we can say four kind of different fields under this category, that is liquid ratio, which will have another part of solvency, then the turnover and the profitability ratio. Now this problem will have a comprehensive problem, or rather this problem itself is called as comprehensive problem because in this illustration you will be solving not just liquidity ratios but a mixture of all other ratios as well. So let's figure out with the illustration that we'll be jotting down here. You can note down that illustration and further go ahead with the calculation of it. So let's figure out one thing. So the question has been mentioned here. We have been given a balance sheet which has liability and asset side. Certain items are mentioned on the liability side, certain items on the asset side, and we have to figure out certain 7 ratios in this. Now let's figure out what do we have as a part of the balance sheet. We have share capital worth rupees 2 lakhs. We have profit and loss account worth rupees 30,000. We have general reserve worth rupees 40,000 here. We have 12% debentures amounting to 4,20,000. We have sundry creditors worth rupees 1 lakh. And we have bills payable worth rupees 50,000 here. Now this is the liability side. The total comes to 8,40,000. Let's go on to the asset side and figure out what exactly do we have there. We have land and building worth rupees 1,40,000. We have plant and machinery worth rupees 3,50,000. We have stock worth rupees 2 lakhs. Sundry debtors amount to 1 lakh itself. Bills receivable amounting to 10,000. And cash at bank being 40,000 here. The credit side total amounts to again 8,40,000, so the balance sheet tallies up. Now the question arises what we have to find out here. So the first ratio that we have to find out is the current ratio. Next is the quick ratio. Next is the inventory to working capital ratio, that is stock to working capital ratio. Next one would be debt to equity ratio, that means all the loans divided to equity ratio, what comes under equity category. Next one is the proprietary ratio. The sixth one would be the capital gearing ratio, rather called as capital ratio itself. And the last one is current assets to fixed asset ratio. That means how many current assets and what is the amount of fixed asset, the ratio between them. So now that we know the problem, let's start ahead with the solutions. The current and the quick asset will be simple for you. The next few will be new for your course. So let's start with the current and quick ratio first. So to describe the current ratio, the formula is current assets upon current liabilities. So let's take the total of current assets and let's take the total of current liabilities of it. So under current asset, we have four items as per the balance sheet that was given to us. We have stock, we have debtors plus bills receivable, and the next we have is the cash balance. And for current liabilities, we have creditors and bills payable. That's a simple thing. We just have to add those total and see what is the ratio that comes up. So we have mentioned all the totals according to the items that were mentioned in the formula. Now we'll be totaling it up and seeing what is the balance of the current, or rather what is the current ratio that comes up. So the ratio that comes up is 2.33. Ideally, it can be also told as 2.33 is to 1. The reason being, I'll tell you, it's in a very simple way. As you see, we have disconnected, or rather we have cancelled out the zeros in green there. So 35 upon 15, it will give you a total of 2.33. That is 1, 15 ones are 15. 15 twos are 30, carry 3 ahead, and that will keep on continuing. So that is 2.33. So the ratio comes to 2.33 is to 1. So the current ratio that I figured out is 2.33 is to 1, or rather you can simply call it as 2.33 because the denominator itself is 1. Now that the current ratio has been figured out, let's go into the quick ratio and see what do we have there. So for quick ratio, we know that the current liability is going to be the same, only the liquid assets are going to change. So only cash or near to cash items are supposed to be selected there. So the liquid assets that we have are debtors, bills receivable, and cash. So the items that we have mentioned here is debtors, bills receivable, cash for the liquid assets, and for the current liability it still remains the same, that is creditors and bills payable. Let's mention the amount and see what is the numerical value that comes up. So if you can see, we figured out the quick ratio as well. The numerator is always 1,50,000 here, and the creditor, or rather we can talk about the denominator, is also 1,50,000 here. So the ratio itself is 1 is to 1. That means quick ratio is 1 is to 1 here. Now let's figure out what do we have under inventory to working capital, that is stock to working capital ratio. Continuation of topic. Now let's figure out what do we have under inventory to working capital ratio. Now to figure out the working capital, the formula is current assets minus current liabilities. Let's do that. So we have the current asset and current liability total as well. The only difference is that what you have to find out. So the working capital mentioned here is 2 lakh rupees by the formula that we calculated right now. So as per the formula, inventory, that is stock value upon working capital, is what we have to find out. Now in the balance sheet we have the stock value. Let's mention that. The stock value as mentioned in the balance sheet is 2 lakh rupees. Now divided by the working capital, which also supposes to be like 2 lakh rupees itself. So again here, if you can find out the one that is highlighted in red, it shows that the ratio is 1:1. We have underlined it with the green part so that it can be differentiated, and that's how the inventory to working capital ratio is figured out. So working capital is basically current assets minus current liabilities. Now let's go on to the next ratio that we have to figure out. The next item that we have to figure out is debt to equity ratio. So the formula here is long-term debts upon shareholders fund. That is the formula for debt to equity ratio. Let's see what do we have under each category. That means long-term debt includes what and shareholder funds includes what. Now, long-term basically or long-term debt basically talks about any kind of debt, any kind of loan that you have apart from the current liabilities. So exclude current liabilities. Apart from that, any kind of big liability that you have has to be taken into consideration. In this question, we have debentures. Similarly, shareholders fund includes the share capital, the reserves, and the profit and loss account. And in the same question, we have these three parts as well. So let's calculate the total of all these items and figure out what is the ratio. So now that we have figured out the long-term debt, that means the total 12% debentures has been taken into consideration, which is amounting to 4,20,000, and share capital amounting to 2 lakh rupees, reserves amounting to rupees 40,000, and profit and loss amounting to 30,000 here. It has been taken into consideration. So 4,20,000 divided by 2,70,000 is the total. If you do it on a calculator, it will give you 1.55555, which equals to 1.56:1. So that is the debt to equity ratio that we have taken. Now let's figure out the next ratio that we have for our reference. So we have proprietary ratio that we have to figure out. Now let's figure out the formula of this first. So if you see, proprietary ratio formula is shareholders funds upon total assets. Shareholders fund has been already calculated in the previous ratio, that is debt to equity ratio, which amounts to 2,70,000. That includes the share capital, reserves, and profit and loss. That is shareholders fund. And total assets is the total value of all the assets that we have, that is amounting to 8,40,000. So if we calculate 2,70,000 divided by 8,40,000, you get a value of 0.32. So that is the proprietary ratio for your reference. Now let's figure out the next ratio that we have to find out. The next ratio that we have to figure out is the capital gearing ratio or capital ratio itself. Now let's figure out what is the formula for capital bearing ratio. So the formula here is fixed interest bearing securities or investments divided by the equity share capital. Now fixed interest bearing capitals or rather securities is something that wherever you have to pay a fixed rate of interest which is secured basically, and that you have to divide it by the equity share capital, that's the share capital of the company. So in this question, we have 12% debentures and the share capital itself. That is 4,20,000 divided by 2 lakh. So the capital gearing ratio here is 2.1 is to 1. That is the capital gearing ratio. Now let's go on to the last ratio that we have to figure out. So the last ratio is current assets to fixed assets ratio. Very simple, current assets divided by all fixed assets. So let's figure out what do we have as a part of current assets in this question and what exactly do we have as a part of fixed assets in this question. So in this asset or rather in this question we have current assets, stocks, we have debtors, bills receivable and cash balance, and for fixed assets we have land and building, plant and machinery. So the total for fixed asset is 4,90,000. The total for current assets is 3,50,000. So 3,50,000 divided by 4,90,000 is what we'll be finding the answer for. So the ratio is 0.71 is to 1. That is the exact ratio that we have to figure out. So as you can see, we have figured out most of the ratios in this specific illustration, which has a lot of simple formulas basically to understand. But this will give you a gist of what is the kind of ratio or what is the kind of format that we're looking out for whenever you have to find out these answers. Make sure you by heart these formulas so that it is easy for you to understand which formula refers to which ratio and what is it exactly that is you need to find out there. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.